Gold, the asset that everyone trades and almost no one understands. You enter a position, you feel like a genius for about 4 minutes, and then your stop loss gets clapped into oblivion. But what if I told you there's a way to actually predict where gold is going before you open the chart? A 3-step formula that completely changes how you trade it. A formula that tells you the direction before you ever touch the chart. And today, I'm gonna walk you through every single step by step, source by source. Let's get straight to it. Everyone says the same thing. When the dollar goes up, gold goes down. True, but it's a surface level observation. The real correlation is something else entirely, and if you don't know it, you're trading blind. Gold has 2 fundamental characteristics. It's an inflation hedge asset, it protects against inflation, and it's a non-yielding asset. No coupons, no dividends. Why does that matter in practice? It means gold competes directly with bonds. When bonds pay well after inflation, investors pull money out of gold to buy bonds. When they don't, they do the opposite. They sell bonds and rotate back into gold. To see it instantly, open TradingView. If you don't have it yet, use the link in the description. In the symbol bar at the top left, type US05Y, the 5-year bond yield, and subtract T5YIE, the 5-year break-even inflation rate, basically the market's pricing of inflation over the next 5 years. What you get is real yields. Now click Compare to add gold on the chart. The picture is brutal. When real yields climbed, gold dropped. The moment they started compressing, gold ripped. Same logic shows up on the dollar side. Here's how to set it up on TradingView in 30 seconds. Pull up DXY. Click Compare at the top, search XAUUSD, add it. Now you've got both lines overlaid on the same chart. Click the DXY label in the top left of the chart, open its settings, and in the Style tab, switch the color to green and bump the line thickness up to 2 or 3 pixels. Do the same with XAUUSD. Switch it to yellow and thicken the line. Now the 2 assets pop off the chart and you can read the divergence at a glance. Then click Indicators, search Correlation Coefficient, drop it in. Double-click the indicator at the bottom, set length to 20. Go to the Style tab, switch the plot type to Area, set the color to blue, and crank the fill opacity up to around 80%. Done. A separate panel appears underneath. Above 0 means they move together. Below 0 means they move opposite. The line ranges from -1 to +1. Now look at it. The line sits in negative territory most of the time. Gold up, dollar down. Dollar up, gold down. Not perfect. There are stretches where it breaks, but the bias is heavy enough that you can't trade one without watching the other. Now that you've got the macro lens, you need an operational method, a checklist to run before every trade. And that checklist has exactly 3 steps: sentiment, fundamentals, technicals. The first step is figuring out who's buying and who's selling gold right now. Not who should be buying, who is buying. 2 tools do the job. First, the COT report. The weekly report showing institutional positioning. Hedge funds, leverage funds, the big players. If non-commercials are increasing longs on gold, that's a strength signal. They see something retail doesn't see yet. Here's how you pull it up on TradingView in under a minute. Open your gold chart. Click Indicators at the top, type Commit in the search bar, and add the first one, Commitment of Traders by TradingView. Once it's on the chart, click the cog to open the settings. Go to Inputs, set the data type to Net Positioning, long minus short, and select Futures only, not Futures and Options. Leave the symbol on auto and it pulls the right COT data automatically based on what you have on the chart. Now go to the Style tab and switch every plot to histogram so you read it like bars. Color them up, commercials in red, large traders in blue, small traders in yellow. That's the standard color scheme used across the trading community. Once you get used to it, you can read any COT chart in seconds. One thing to keep in mind, the data updates every Friday end of day, but it's based on the previous week's positioning. So you're always looking at slightly lagged data. Doesn't kill the signal, just means you're using it for bias and confirmation, not split-second timing. How to read it. When commercials are heavily net long and large speculators are short, that's the bullish setup. Commercials are the smart money, the producers, the miners, the people who actually deal in physical gold. Large specs are usually wrong at the turn, retail traders even more so. So your read is simple: commercials long plus large specs short plus retail long equals high probability buy zone. The opposite alignment flags a short. Second, retail sentiment. And here the logic flips completely. Retail sentiment doesn't have a clean trading view indicator. The cleanest free option is My FX Book. Completely free, no account, no sign up. Just open the page and the data's there. Open myfxbook.com. Click Community in the top menu, then Sentiment. You land on a table with all the major pairs and their long-short breakdown. Scroll down to XAUUSD. Gold sits near the bottom of the alphabetical list. Hover over the row and you get the full tooltip. Percentage long, percentage short, volume in lots, number of open positions on each side. There's also an average short price and average long price column that tells you where retail is currently sitting and how deep underwater they already are. That's your second data point, and here's why it matters. If retail is ultra bullish on gold, say 85% long, that's a warning, not a confirmation. Why? Because the market doesn't pay the crowd. The market pays the side that controls the flow, and 90 times out of 100, that side is institutional. So, COT bullish plus retail bearish equals ideal setup for a long. COT bearish plus retail bullish, get ready for a short. Step 2. Fundamental analysis. You've mapped who's positioned. Now you need to know whether the fundamentals give you tailwind or headwind. 4 questions, 4 answers, nothing more. Question 1. Is US inflation rising? If yes, bullish gold. When prices climb, money loses value. Gold has been the inflation hedge of choice for thousands of years. Investors run to it the moment the dollar starts buying less. Question 2. Is the Fed in hawkish mode? Hiking rates or about to? If yes, bearish gold. Higher rates make bonds and cash more attractive. They actually pay you to hold them. Gold pays nothing, so it loses ground every time the Fed turns hawkish. Question 3. Is the USD outlook bullish? If yes, bearish gold. Gold is priced in dollars. A stronger dollar mechanically means a lower gold price. Same ounce, just measured in a more expensive currency. The two move opposite, almost by definition. Question 4. Is the global outlook positive? Risk on, calm markets? If yes, bearish gold. When the world feels safe, money flows into stocks, growth, risk. Gold is the asset of fear. When fear disappears, so does the bid underneath it. Now, and only now, you open the chart. Direction is already decided by the previous 2 steps. What you need here is timing. Where to enter, where to put your stop, which level to watch. And gold has its own technical rules. They're not Euro USD's rules. They're not Nasdaq's rules. They're specific. 3 key points cover most of it. Point 1. Gold respects order blocks more than any other level. More than fair value gaps, more than range equilibriums. If you have to pick a level to enter on, the order block is first on the list. Fair value gaps only work when they overlap with an order block. On their own, on gold, they get ignored 70% of the time. Point 2. Gold follows market structure brutally. To confirm a trend, you need at least 2 consecutive breaks of structure in the same direction. One isn't enough. One is a trap. And once the trend is confirmed, don't fight it. Shorting gold inside a strong uptrend is like swimming against a tsunami. Stay with the flow. Point 3. Gold loves manipulation wicks. But not just any wick. A manipulation wick has 2 specific conditions. First, the wick has to sweep liquidity. Take out a previous candle low, a previous high, any major level where stops are sitting. Second, the candle has to close back through the previous candle in the opposite direction. Sweep plus reversal close in a single candle. That's the signature. When you spot it, the wick itself becomes a POI, a point of interest, the zone where you wait for price to come back and pull the trigger. Not the body of the candle, the wick. Mark the wick with a Fibonacci tool. Anchor it from the high of the wick to the low. You'll get 5 reaction levels: 0%, 25%, 50%, 75%, 100%. Gold tends to retrace into one of these levels before continuing, with 0% and 50% being the two most reliable for continuation entries. Mapping order blocks, BOS, fair value gaps on gold by hand at end of day takes hours, and gold creates a lot of them, especially during the London-New York session overlap. That's why I use Flux Charts, a TradingView indicator site that auto-plots the entire SMC structure on the chart. Order blocks, BOS, chalk, fair value gaps, liquidity zones, in real time. Nothing to draw by hand, nothing to update candle by candle. Open the chart, everything's already there. Now we put it all together on a real trade. It runs on 2 time frames. Higher time frame, 30 minutes or 15 minutes for the map. Lower time frame, 5 minutes or 1 minute for execution. The first thing you're hunting is a liquidity sweep, a move that takes out a key level and then rejects sharply. In Flux Charts, open the indicator settings and enable the liquidity grab option. Bullish liquidity grabs will appear on the chart as small green circles, bearish ones as red circles. Right after the sweep, what you need is a break of structure in the opposite direction. Sweep down, BOS up. Sweep up, BOS down. Activate the BOS and chalk checkboxes in the Flux Charts settings. Both events get plotted automatically with labels. Once you've got the sweep plus the BOS, you go find the order block that generated that move. It's the last candle going against the new direction, the one right before the explosive leg up. That's your high time frame point of interest. Quick reminder on what an order block actually is. A decisional zone where institutions placed large volume right before a major expansion. In a bullish setup, the order block is the last down close candle right before the bullish leg that broke structure. Flux Charts plots them automatically once you enable the order block option in the settings. 2 settings worth knowing: the invalidation method, close or wick, depending on how strict you want to be about when the zone is broken, and sensitivity, which lets you filter out smaller order blocks if you only want to trade major displacements. Now you wait. Don't enter yet. Let price come back into the order block on its own. Once price reaches the area, drop down to the lower time frame and closely monitor the price action for signs of reversal. These signs could include a market structure shift, a change of character, or other reversal signals such as IFVGs. That's confirmation that the selling pressure that pushed price into the order block is now exhausting itself. We are looking now for a violated fair value gap that flips into an inverse fair value gap, an IFVG. Enable the fair value gap option in Flux Charts to track them in real time. When a bullish FVG gets violated and price closes back above it, the gap flips polarity. It now acts as support instead of resistance. The IFVG is your entry trigger. You've got 2 ways to play it. The aggressive entry, enter at the open of the candle right after the IFVG forms, stop loss below the recent low. The conservative entry, place a buy limit at the high of the IFVG, wait for the pullback into the zone, stop loss below the recent low. Conservative gives you a better risk to reward. Aggressive catches the move more reliably but with a wider stop. Pick based on your style. For the take profit, target the nearest pool of liquidity on the current time frame. Or if you're playing for a larger move, a key level on the higher time frame. And one more layer, the add-on. If price moves your way and prints a fresh BOS, a new fair value gap almost always forms inside the expansion leg. The FVG becomes your second entry. Buy limit at the high of the gap, stop below the swing low. It's an add-on that amplifies the trade's return without significantly raising risk. For the bearish scenario, same workflow, mirror direction. It still runs on 2 time frames, 30 or 15 minutes for the map, 5 or 1 minute for execution. And Flux Charts still does the heavy lifting. You start on the higher time frame, hunting a bearish liquidity sweep, a move that takes out a key level above, a significant high, a resistance zone, a previous swing high where stops are sitting, and then rejects sharply downward. The liquidity grab option in flux charts will plot it as a red circle. Right after that sweep, you need a break of structure to the downside. Sweep up, BOS down. The BOS and chalk checkboxes will flag it automatically. Then you go find the bearish order block, the last up-close candle right before the bearish leg that broke structure. That's where institutions offloaded and price is likely to come back and retest. The order block option in flux charts plots it as a colored zone. That's your high time frame key level. Wait for price to come back up into the bearish order block. Same patience rule. Don't enter early. When price reaches the zone, drop to the lower time frame. On execution, you're looking for a bearish change of character, confirmation that the upward push is exhausting itself and sellers are stepping back in. Right after the change of character, you look for a bearish fair value gap that gets violated upward and flips into a bearish IFVG. When a bearish FVG gets violated to the upside and price closes back below it, the gap flips polarity. It now acts as resistance instead of support. That's your entry trigger. Same two options on the entry. Aggressive, enter short at the open of the candle right after the IFVG forms, stop above the recent high. Conservative, place a sell limit at the low of the IFVG, wait for the pullback up into the zone, stop above the recent high. Same trade-off applies. Better risk to reward versus higher hit rate. Take profit is the nearest pool of sell-side liquidity on the current time frame, typically a recent swing low or a previous demand zone, or a higher time frame key level if you're playing for a larger move. The liquidity grab feature alone is actually available for free on flux charts. However, if you want to unlock the full potential with all the advanced features including volumetric order blocks, enhanced fair value gaps, and comprehensive market structure analysis, the complete price action toolkit is available with 20% off through the link in the description using the code TradingNotes20. I do earn a commission when you use my link, which helps me continue creating free educational content like this video. But here's the thing, this indicator is genuinely valuable and something I would recommend even without any sponsorship. Thanks for watching and see you guys next time.